Hi, this is Finance Investing, just Joey style. And I want to talk to you about stablecoins and tokenization and how the banks are going to pull liquidity out of that. So, what I believe is going to happen over the next 3-ish years, the SEC, Congress, everybody, DTCC, they've already basically stated that they're going to tokenize the entire stock market. So, in the next 3-ish years, they're going to tokenize everything, which means that they're going to digitize it and allow things to be more exact and be more specific and then move quicker. It's a digital version of everything. So, and it pulls liquidity in. So, what I think is going to happen is that this is going to cause markets to rise quickly, fall quickly, but also have more V shaped recoveries. So, it's going to be a trader's paradise, I think, over the next 3 years, but also mostly bullish. I have a document that I'm going to basically read from that I created last night to show you how they can do this. So they're basically creating QE, which is quantitative easing, but they're not really inflating the money supply. They're pulling specific value out of high quality assets and taking that and using that money somewhere else. And they can move it fast. It's very similar to selling a covered call on your assets. So if you understand how to sell a covered call, you're going to understand tokenization and why liquidity can be pulled out. So I can have 100 shares of stock, sell a call, make money, and I can use that money instantaneously anywhere I want to, and I still hold my asset. Okay. So stablecoins, banks, tokenization, and why the next bull run won't look normal. So, all right, today we're going to talk about something that almost nobody is paying attention to, but it might quietly define the next market cycle. We're talking about stablecoins, banks, and Dodd-Frank. That's basically the Financial Stability Act of 2010 that was created whenever they almost destroyed the entire financial system because of the dumb crap they were doing. Anyhow, and why the next liquidity wave will probably won't look like QE, even though functionally it behaves a lot like it. This is not hype. This is financial plumbing. All right. Why Dodd-Frank exists. After 2008 crisis, the Dodd-Frank Act was passed to stop banks from taking massive risks without capital backing them. So higher capital requirements, lower leverage, and systematic risk oversight. And it worked for the financial system that existed at the time. Now, when this was put in place, stablecoins weren't a thing. That's very important to understand. So, but Dodd-Frank was written before stablecoins, tokenization, on-chain settlements, and programmable money. So that's basically what crypto does. So it regulates banks, not modern liquidity rails. Stablecoins are liquidity rails. The Collins Amendment. So, Section 171, the Collins Amendment says banks must keep capital requirements with no special exemptions. Normally, if something is on banks' balance sheets, it requires capital. Here's the twist stablecoins are being defined as payment instruments, not securities, not traditional deposits. And under emerging legislation, certain stablecoin structures are explicitly carved out from parts of the Financial Stability Act. That's the wedge. So, in the Genius Act, in the Genius Act, we'll get to this in a second. Um, it states that stablecoins are not subject to Dodd-Frank. Okay, this gets interesting. Critical clarification. Let's be precise. Stablecoins are not unlimited money printers. So when I was first deep diving this, I personally thought that they could just create stablecoins like they do money. They could just print it, right? No, they cannot just create a stablecoin. It has to be backed by something. But that's where tokenization comes into play. When they tokenize those assets, they can pull the value out of it, like I said, like a covered call. Stablecoins must be backed one for one by high quality liquid assets like cash, bank reserves, and short term treasuries. So, no, banks can't mint infinite money out of thin air. But why this still acts like QE, which is quantitative easing, money printing. Liquidity is not just money creation. That's what they were doing with money printing, creating more liquidity by printing it. Liquidity is speed, reuse, and velocity. So when you can move something quicker and reuse it, that also creates something similar to QE. Stablecoins convert slow assets, locked capital, and inert balance sheets, okay, into instant spendable liquidity. This is the covered call. I have 100 shares of stock. I can't do anything with that stock. It's worth this much, but unless I want to sell those shares, I can't do anything with that money. But I can sell a covered call and get some liquidity out of it. Okay, so stablecoins turn into instant spendable liquidity. Same money, more economic work. That's why the effect feels like QE, even if the mechanism is different. So they're pulling value out of something, creating liquidity, taking that money and being able to place it in other places quicker, faster, efficiently. Where liquidity goes. Liquidity doesn't sit still. It flows into growth stocks, AI, crypto, tokenized assets, and anything with upside convexity. Okay. When markets believe liquidity will show up instantly, risk appetite explodes. That's how melt ups happen. So think about it. If the market is kind of in trouble, the country generally does things, SEC, there's different ways to prop things up. Well, now they can prop things up faster. So if there's bad times coming, if there's hard things happening, they can pool liquidity and make things better quicker. So this improves the risk appetite of investors. So anything that's considered a little bit more risky, when liquidity is there and instant liquidity, risk appetite on. This is why I believe we're going to be on about a 3-year bull run. We're going to have the volatility. So, but it's going to be straight up because they can pull liquidity quick. Why the Clarity Act matters. Clarity is not about slowing things down. It's about unlocking institutional participation. So, Clarity Act basically defines what assets are. Okay? So it's kind of like walking or you come up to a dark alley and maybe your 5-year-old's with you. You're not going to send your 5-year-old down a dark alley because it's not safe. You can't see what's in that alley. You don't know what's going on. There's no clarity. But if it's a sunny day and you can see that there's no dangers going down this alley, you're okay sending your 5-year-old down there because you can see what's ahead of you. So Clarity Act lets institutions see what's ahead of them. Okay? So that's what's going to unlock the institutional participation. Stablecoin legislation built the rails first. So, Clarity Act defines what assets can run on them. Clarity defines what assets can run on them. Okay? The stablecoins built the rails that the assets can run. Clarity is going to define what assets run on those rails. So, it's highway before traffic. So, they built the highways. The stablecoins was the highway. I couldn't figure out why they would build stablecoin legislation before Clarity because it's the infrastructure and they needed to be prepared on how they could pull liquidity out before they let the floodgates open. Once institutions know the rules, capital doesn't hesitate, it floods. So the rails are built, the highways are there, the stable coins are here. Once clarity comes out, boom, capital flows. And then when more and more tokenization comes out, there's more and more capital from high quality assets that can be pumped into the market. So the takeaway, stable coins don't create fake money. They extract maximum liquidity from assets the system already trusts. That changes market behavior permanently. And if you understand the plumbing, you see the moves before they happen. I'm telling you, get prepared. This market is going to go crazy. And tokenization Stable coins are going to create so much liquidity that it's going to blow your mind. These are going to be exponential moves in the next 2 to 5 years are really going to show you what I'm talking about. So, yeah, liquidity, it's coming. It's definitely coming fast and hard. So, if you're not investing in crypto, I think you're kind of an idiot. So, if you don't understand it because it's going to run the new financial system and they're doing it right in front of everybody's face. You just need to know what to look for. So, this is Finance and Investing Just Joey style, and I highly recommend that you invest into the best of the best crypto assets that have proven themselves for a long time. And there's about 10 of them right now that are really, really good. 10, 20 of them that are really good. So, anyhow, liquidity's coming. Liquidity is coming. It's very, very important for markets to move.